All right, here we are again. I hope you guys are doing well. How was the homework?
So easy.
It was so easy. It was so easy. It was not very hard assignment, so hopefully you didn't struggle with it too much. So let's go ahead and dive right in there, okay? I believe this was the assignment, was it not? Quick study 13.1, 13.2, 13.3, and exercise 13.1. Is that right? Okay.
Oh, yeah.
All right, let's go ahead and go over that. We might do them in a little different order than what you did it. It's okay. Let's do quick study 13.1 first, okay? Now, we started talking about the corporate form of business, correct? So this question says, of the following statements, which are true for the corporate form of organization? Okay? All right, let me just go ahead and put that up there. And what I kind of like to do is, let's just treat, let me move this down, adjust it a little bit. Let's just kind of treat this as a true false for each one of these. Does that make sense? So let's just kind of go through these and say, is this statement true or false in regards to the corporate form of organization? All right? So, okay, true or false for corporation, ownership rights cannot be easily transferred.
False.
That is false. They can be easily transferred, right? Okay. Number 2, owners have unlimited liability for corporate debts. That is also false. It's one of the big advantages of a corporate form of organization is the limited liability for its owners, correct? Number 3, capital is more easily accumulated than with most other forms of organization.
True.
That is true. Of course, you're selling, ownership in the company, but it's still true. Number 4, corporate income that is distributed to shareholders is usually taxed twice.
True.
That is true. And let me just add a little sad face there, because that's the big drawback of a corporation, okay? It is a separate legal entity.
True.
That is true. A corporation is a separate legal entity. Partnership is not a separate legal entity, okay? 6, it has a limited life.
False.
That is false. And owners are agents of the corporation.
Are not agents.
That is true or false?
It's true, but
Owners
you
are not
said
agents.
Did I say it wrong?
Yeah.
Let me read number 7 again. Owners, true or false? Owners are not agents of the corporation.
True.
That's true.
That is true. That is true that owners are not agents of the corporation. They cannot conduct business for the business, okay? So owners are not agents of the corporation. That is a true statement for the corporate form. All right? Great. Okay, then we had, let me hop over, and exercise 13.1 says, describe how each of the following characteristics of organizations apply to corporations. Okay, this is another one of those, you can come off that. This is another one of those that is like, I'm not sure, I'm 100% sure what they're asking for here, okay? And that's understandable. Some of this actually probably would have had to come from your reading anyway. So let me just put the answer up there, and you can just leave it up there while I talk through it, okay? Okay. This is all in regards to corporation. What about owner, authority, and control? Well, as you might have read, and we've kind of alluded to this, there's shares of stock. Shareholders can vote. Common shareholders can vote. There's 1 vote per share. So the more shares that you own, the more votes that you have, okay? Ease of formation. Well, it does require a government approval to get a corporation. You have to fill out the paperwork. You have to pay some fees. There's some regulations that you have to follow. Number 3, the transferability of ownership. It's readily transferred. It's easy to transfer, okay? Now, we're really talking about a publicly held corporation at this point, okay? One that can be bought and sold on the New York Stock Exchange or the NASDAQ or whatever, okay? The ability to raise large amounts of capital, there's a higher ability with corporations, okay? But again, you're selling ownership, all right? The duration of life, well, it is unlimited, right? Has an unlimited life. Even if an owner dies, the corporation keeps going on. And that makes sense. I mean, think about a company like PepsiCo that has thousands and thousands of shareholders. Chances are there's going to be a shareholder that dies here this month or this year, right? But yet the corporation is going to continue on. Owner liability is limited. That's good. Legal status. It is a separate legal entity, as I said. And the tax status, well, it states corporate income is taxed and its cash dividends are usually taxed at the 15% rate. I don't really care that you memorize that rate. The main thing I want you to know is that it has the double taxation. All right? Okay? Any questions on that? Any questions on that, folks? If not, let's do the, and I know we still have a couple quick studies to do, but let's go ahead and do the handout, the stock issuance handout. All right? So, all right. Prepare the journal entry to record System Technologies issuance of 100,000 shares of its $1 par value common stock, assuming the shares sell for, what if they sell for $3 per share? Now remember, we are looking from the standpoint of the corporation, the one that's issuing or selling the stock. We are not looking from the perspective of somebody buying it, okay? All right, well, you sell 100,000 shares for $3 per share. How much cash is coming in? 300,000. And this is why we sold this stock, is to raise this capital, right? We credit common stock, and you guys can abbreviate a little bit if you'd like. And what do we credit it for? What amount? 100,000, which is the number of shares sold times that arbitrary par value or whatever. Okay? Well, that journal entry doesn't balance, so what do we credit for 200,000? Additional paid in capital, or sometimes I just abbreviate that, APIC. Remember, these are both equity accounts. They are both on the balance sheet in the equity section. They both have credit balances, okay? The par value just determines how much is credited to common stock versus additional paid in capital, correct? Okay, good. What if the shares of stock are instead sold at $5 per share? Well, cash would be debited for 500,000, correct? And what would we credit common stock for? What do you think?
100,000.
100,000. And then additional paid in capital is credited for 400,000. Is that correct?
Yep.
Okay, good deal. Any questions on those two? All right, next one. Prepare the journal entry to record Kirchhoff Inc.'s issuance of 40,000 shares of $5 par value common stock, assuming the stock is given in exchange for a building valued at $370,000. Okay, well, it's really not much different than when we sell it for the asset of cash, except we don't debit cash here because we didn't receive cash. We received a different asset called building, right? So we debit building for $370,000, okay? We credit common stock, again, for the number of shares issued times the par value of the stock. We issued 40,000 shares for $5 each. What's 5 times 40,000?
200,000.
Okay, that journal entry doesn't balance, so we credit additional paid in capital. You with me? Any questions on that? Okay, let's do the last one. Prepare the journal entry to record Celestron Company's issuance of 60,000 shares of no par value stock, assuming they sell for $20 per share. Now remember, some stock does not have a par value attached to it at all. It's no par stock. So this is always pretty easy. You debit cash. How much cash came in? 60,000 times 20.
1.2 mil.
What is that, 1.2 million? Is that right? Okay. And then we simply credit common stock. And you know, in parentheses, you might put no par. I probably wouldn't take off on a test if you didn't put no par in parentheses. But that's the journal entry right there. Okay? Any questions on any of that? Yeah.
For a test with the par value stocks, do you want us to put the par values with it or no?
Like the par, like looking back at here,
Yeah, just put like
saying
par
common
value,
stock,
$5.
$5 par value.
Yeah.
You don't have to do that. You don't have to do that. You might find that in practice, or I'm sure the book did that, but you can abbreviate a little bit. Okay. All right. Now the only other thing we need to go through are those two quick studies. Is that correct?
Yes.
So let's go ahead and do that. That was quick study 13.2 and 13.3. Okay? Let's take a look at those. All right. Kind of a glare there, isn't there? Can you guys see that? It's the top two. Okay. Good enough. All right. Quick study 13.2. Prepare the journal entry to record Autumn Company's issuance of 63,000 shares of no par value common stock, assuming the shares sell for $29 per share. And then the second situation, what if they're exchanged for land valued at $1.827 million? Okay. Well, let me just put both of those up. I don't think that should have been too difficult. Okay. All right. In the first situation, you debit cash for $1.827 million and you credit common stock. And again, if you put no par value after that, that's fine. You credit common stock for $1.827 million. Okay. In the second situation, everything is the same except we don't debit cash, we debit land. Is that correct? All right. Okay, let's read the next one. Quick study 13.3. Prepare the journal entry to record Zende Company's issuance of 75,000 shares of $5 par value common stock, assuming the shares sell for, what if they sell for $5 per share? Well, if they sell for $5 per share, how much cash comes in? It just so happens that in this case, they sell for their par value. That's very, very rare. Okay. But if that was the case, then that would be the journal entry. There's no additional paid in capital above par. Okay. By the way, and I reminded you last lecture, you know, this is not a law class, so we're not delving into all the legal implications of everything. But for your purposes, the market price will always be greater than the par value. Okay. Always be greater. It certainly will never be less. Okay. And I think an attorney told me once that if the market value through the supply and demand ever drops below par value, some legal ramifications kick in. But again, we don't really need to be aware of that. Just know that really for your purposes, par value is never going to be greater than market value. Market value will always be greater. Does that make sense? What we sell it for will be more than par, which is what we have in the second situation on this quick study. What if it sells for $6 per share? Well, we debit cash for $450,000, which is the number of shares issued times the market price. And then we credit common stock for $375,000, which is the number of shares issued times the par value. And now look, they used a different account, didn't they? They didn't use additional paid in capital. If you used additional paid in capital, that's fine. But they said paid in capital in excess of par. And we had that slide last time that says, hey, you're going to see some different accounts that look kind of similar. They're all just different names for the same type of account. Okay. Now, one company is not going to keep switching what they call it. They're going to pick one of those and stick with it. But, you know, between different companies, you'll see little variances as far as that last account. All right? Questions? All right. Well, let's talk about our next subject, okay? If there's no questions on the homework. What I want to talk about now is our cash dividends, okay? I don't think this is too hard of a section, but I got to tell you, for some reason, students always struggle with this question on the test. And I think I know why, and I'll tell you here in a little bit, all right? Cash dividends are payments that a corporation can pay out to its stockholders or investors, okay? And they usually always affect the stock value, okay? Now, let's talk about my PepsiCo stock. Every quarter or so, a dividend check comes. And it's, you know, I didn't have that much shares of stock, but it would be about, oh, you know, $25 or so, okay? I didn't have much stock, okay? And that is just a payment to me, the owners. All the owners got them. The more shares you owned, then the more dividends in total that you received, okay? But we've heard this term dividends, right? Now, there are three important dates that I want you to know about. There is the date of declaration. That is the date we record the liability for the dividend, okay? Then there is the date of record. The date of record. There's no journal entry needed on the date of record. And what the date of record is that is the date that you must own the stock by to receive that dividend, okay? And then there's the date of payment when we as the corporation send out the checks, okay? Let's talk about these. Let's go through an example. On January 9th, a $1 per share cash dividend is declared on Dana Inc.'s 10,000 common shares outstanding. The dividend will be paid on March 19th to stockholders of record on February 19th. Okay? You with me? Now, a couple of things real quick. Now that we see this example, let's use this date of record. What is the date of record? February 19th. Okay, let's come off that real quick. Okay? If you buy your stock, Jeremiah, on February 17th, you will get that dividend. If you buy yours on February 18th, you will get the dividend. If you buy your stock on February 19th, you will get the dividend. If you buy yours on February 20th, you will not get that dividend. You'll get the next quarterly dividend. But you got to draw the line somewhere, and that's what the date of record is. Does that make sense? And usually, theoretically speaking, the price of the stock drops a little between the day you buy it and the day you don't, the day you buy it, because you're receiving something that you aren't. Does that make sense? Okay. So we don't really know how much it drops by because it's very hard to isolate. There's so many other things happening. So, but theoretically, the stock price drops a little bit after the date of record. Okay, let's talk about this journal entry for the date of declaration. Take a look at it. We debit retained earnings and we credit common dividends payable. Okay? We debit retained earnings and credit common dividends payable. Okay? Now, have we talked about retained earnings? Okay? We have, haven't we, Creighton?
It's like the replaces capital.
Yes. Michael, you cracked me up because you're here's what retained earnings is like. Remember this slide back here? Do you remember that slide?
Yeah, with the stars all over
Yeah,
it.
yeah. Come off that for a second. Let's say let's say that I had a regular group of people that my wife worked with that we would go out with on weekends and, you know, socialize with. Well, let's say the first time I went to that party, I'd never met any of these people. And so my wife says, hey, this is my husband. His name is Dave Krug. And I go, hi, I'm Dave Krug. I work at the college. I teach accounting. And I have got a couple teenage sons. And I shake their hands, and they all get to know me, and they talk with me and all that. And next week comes, and we go to the same party. And I go to the party, and I see those same faces. And they all go, now who are you? And I go, don't you remember we met last week? I said, I'm Dave Krug. I teach accounting at the college. And remember I have 2 sons? And they're like, oh, I don't really remember you saying that. But okay, well, it's good to meet you. Okay. Well, the next week comes, and I go to the same party, see all the same people again. And I say, hey, how are you guys doing? And they look at me like, who are you? And who are you? And I say, don't you remember? I'm Dave Krug. I work at the college. I teach accounting. I have 2 sons. Okay? Well, why do I tell that story? Because that's how retained earnings is, okay? I always introduce retained earnings. Take a look at this slide. I talk about what retained earnings is. It's a very important account. And I give you these details on it, and for some reason, Michael, your reaction is everybody else's. Have we talked about retained earnings? People go, who are you? Who are you? I don't think we've met. Yes, we've met. We've met before. Don't you remember? Okay? So that's okay. I expect that. Retained earnings, let's go one more time. Retained earnings is like the capital account that you worked with in Accounting 1. Okay? It is a credit balance equity account. Remember how capital increased with net income and decreased with net losses? Same way with retained earnings. It's just what we call it in with the corporations. We don't call it capital. We call it retained earnings. So retained earnings increases with net incomes and decreases by net losses. Do you remember how with capital, in regards to partnerships and sole proprietorships, how capital would decrease with owner withdrawals? Well, it's the same way with retained earnings, but we don't always call it owner withdrawals. What do we call it when cash leaves the company and goes to the owners? Dividends. We call it dividends. Okay, so look at this point. Retained earnings is decreased by payments of dividends or owner distributions. Now let's go back to that journal entry that I told you, and I think it should make sense. This is the date that we declare a cash dividends. We credit this account called common dividends payable, which is just like any other liability, okay? And we debit retained earnings. Now, retained earnings has a credit balance, correct? Thus, when we are debiting retained earnings, we are in fact decreasing it, right? Does that not make sense now that we have reacquainted ourselves with retained earnings? Because this is a distribution. It's like a withdrawal. Cash is leaving the company and going to the owners, which is fine, but that decreases retained earnings. You with me? But I think the reason that on tests people always mess this journal entry up is they don't remember. I don't think Krug ever talked about retained earnings, okay? So think through that. Understand what retained earnings is first, and then I think this will make sense. Jeremiah.
So for like big corporations like Sprint or something like that, that's going to be like in the millions or billions of dollars.
Oh,
right?
yeah. It's going to be a big old number.
Okay.
But of course, their beginning balance of retained earnings will be even larger.
Okay.
Okay? But yeah, it'll be some large numbers. Okay? Okay. So that's the date of declaration journal entry when we record the liability for the dividend. Let's take a look at that one more time, because now we're going to go on to the date of record. No journal entry is required on the date of record. That's just the date you have to own the stock by. And then you've got the date of payment. Date of payment, pretty easy. It's on March 19th in this example, and it's just the payment of that liability, and it looks just like any other journal entry when we pay off a liability. Cash is credited because it's decreased. The liability is debited because it is also decreased because we've just satisfied that liability. Does that make sense? Okay? That is always on the test, but again, for some reason, students really have a hard time with that. So let's go ahead and do this. I've yacked long enough. Let's go ahead and do quick study 13.7. It won't take long, but let's go ahead and do quick study 13.7 while they play that music. All right? I'll go ahead and lay the question on the overhead. Okay, I'm not going to reread that because you just read it, but not too difficult, is it? Let's go ahead and take a look at the answers real quick, okay? July 15th is the date of declaration. We debit retained earnings for $165,000, credit common dividends payable for $165,000. Date of record is August 15th. There's no journal entry, okay, needed. Did I say that right? August 15th is the date of record, no journal entry. August 31st is the date of payment. We credit cash. We debit common dividend payable for $165,000. It's just that easy, isn't it? Okay, any questions on that?
Do you want us to write down that there's no formal journal entry required?
That's a great question. Do you need to write that down? I would say you don't need to, as long as you put dates there. So I know that you recognize that the date of declaration is July 15th and the date of payment is August 31st. So, you know, if you didn't put dates, then there'd be a trouble. But you don't have to write no entry if you put the dates. Okay? You should always put the dates anyway. All right, questions? Okay, what's the normal balance of retained earnings? Remind me.
Credit.
It's a credit balance. Now, what reduces retained earnings? One of the things was a net loss for the company, right? Well, take a look at this slide here. This is a situation where the retained earnings has an abnormal debit balance. It actually has a negative balance. Okay, that means that the cumulative net losses have caused that to go negative, caused that retained earnings to be a debit balance. Now, usually when a company has or oftentimes when they have a retained earnings deficit is what we call that, when it's a negative balance, they're not allowed in their charter to pay dividends, okay? They're not allowed in their charter to pay dividends, okay? One other thing about dividends, and you can come off that real quick. Are dividends required to be paid? Do we have to pay dividends?
No.
Yeah.
No, we don't. You do not have to pay.
There's some companies that don't pay.
There are some companies that don't, and a lot of brand new companies say, hey, we're not going to pay you cash dividends because that's cash leaving the business. What we're going to do, we want to keep that cash, reinvest it in new products, new technologies, and hopefully that'll cause your stock price to go up even more and you'll benefit that way, right? There's a lot of new technology companies that do not pay cash dividends. You're not required to pay cash dividends. However, let me say this. Once you start paying them quarterly, usually is the way they pay them, once you start paying cash dividends quarterly, companies are extremely reluctant to not pay them each quarter. And why would that be?
When you start paying it, you get more long-term stockholders who are more vested in receiving that income.
Yeah, but narrow it down. What if...
You get people who rely on that salary.
Well, that is true. You get people who rely on that. And a lot of elderly people have enough stock investments that their dividends is what they live on. But let me ask you this. You guys know the answer to this. If a company has paid dividends every quarter for 18 years, and all of a sudden they say, we're not going to pay dividends this quarter, what do you think is going to happen to the stock price?
It's going to drop.
Ooh, that's not a good sign to the market. Stock prices will go down. Okay? So once a company starts paying dividends, even though they're not required, they usually keep it up because they don't want the drastic effect on the stock price. Okay? But in this case, looking back at the slide, a lot of times the corporate charter will not allow you to pay dividends if your retained earnings goes negative, if it has a abnormal debit balance. All right?
Well, you wouldn't want to anyways, because then that's just going to cause you to be even more.
Yeah, then it would cause the deficit to even be greater. You're exactly right. Okay? All right. There's retained. I think you guys have had enough of retained earnings. Okay? Let's talk about preferred stock. What is preferred stock? Preferred stock is a separate class of stock, typically having priority over common shareholders in regards to two things: dividend distributions and distribution of assets in case of liquidation. Now, this is the main one, okay? So let's talk about that, okay? Let's come off that real quick, okay? Henry, let's say you're a common shareholder. Ling Fei, right? Let's say you are a preferred stockholder, okay? Well, I don't have to pay dividends. But if I do, I have to pay Ling Fei, the preferred shareholder, before I pay you, the common shareholder. Okay? That is the main preference when it says preferred stock, that you get Ling Fei as a preferred shareholder. You get paid dividends before you do. And if I don't have enough money to pay you both, only you. Okay? Now, the other benefit you receive, and this is one you hope you don't have to invoke, but as the slide says, going back to it, distribution of assets in case of liquidation. If my company goes out of business and after I pay my creditors, and if you want to stand in line trying to get some of your money, well, you will be ahead, Ling Fei, you will be ahead of the line as compared to Henry, because you're the preferred shareholder, he's the common shareholder. So you'd be ahead of him in line. But that's a whole situation that neither one of you hope ever happens. The main preference is in regards to dividends. Okay? Now, take a look at the slide. We're going to find out that preferred stock usually has what we call a stated dividend rate. It almost acts like an interest rate. And here is the big one. Preferred stock almost always, and for this class you can almost say always, has no voting rights. Preferred stockholders have no voting rights. Okay? Coming off of that, let's think about the implications of this. Henry is my common shareholder. Ling Fei is my preferred shareholder. Now, I hope I'm the management of the company. I'm the top management of the company. I hope you're both happy with me. But if I can only have one of you be happy with me, who do I want to be happy with me? Right. Henry, correct? And why is that?
Because there's less responsibility to take care of.
Because he votes. He can vote me out, right? Go to politics. Do politicians care more about the groups that vote or the groups that don't vote?
Groups that vote.
The groups that vote. This guy can vote. She can't vote. So I will hope you're both happy with me, but I really want you to be happy. So I'm in a situation here where I have to pay you dividends first before I can pay him. Okay? But I want him to be happy because he can vote my Fanny out of a job. Okay? Does that make sense? Okay? Talk about this a little bit. And this is going to be one of those subjects that's going to make a lot more sense when we start doing examples. Preferred stock is either cumulative or non-cumulative. What does this mean? Well, let's talk about non-cumulative. Non-cumulative means that if I didn't pay dividends in the past, I do not have to pay those past year dividends to the preferred shareholders before I pay the current shareholder to them and then eventually to the common. Let's flesh that out with an example. This will be better illustrated with an example. Let's say it's 2016 and I did not pay any dividends in 2014. I did not pay any dividends in 2015, and now it's 2016, and I want to pay some dividends. Well, if your preferred stock, Ling Fei, is non-cumulative, the years that I did not pay dividends, 2014 and 2015, so sad, too bad. Now, I do have to pay you 2016, your current year preferred dividends, before I can pay you any dividends. But those other years where I shorted you and didn't pay, sorry, it's non-cumulative.
So would you have paid dividends before 2014?
Let's say the company started in 2014 for ease of that example. Okay? Let's look at the next one. Now, most preferred stock is what we call cumulative. Most preferred stock is cumulative. And what that means is we have something called dividends in arrears. And that means those years where I did not pay, I have to pay those before anything goes to the common shareholders. Most preferred stock is cumulative. Let's go back to this example. The business started in 2014. I did not pay any dividends in 2014. I did not pay any dividends in 2015. It is now 2016. And let's say your preferred stock is cumulative, like most preferred stock is cumulative. That means I have to pay you, go back and I have to pay you your 2014 amount, your 2015 amount. Those amounts are called dividends in arrears, the amounts I shorted you in the past. Then I also have to pay you your 2016 current year amount. Now I am finally clear to give some dividends to my common shareholder, Henry. Do you see the difference? Okay, cumulative versus non-cumulative. Okay, now we're going to take a look at an example. In this example, we're going to do two examples real quick. Let's do the one first on the screen. Okay, let's read through that. Any questions? Okay, I know this might be a little fuzzy right now. Hang with me. Okay. Consider the following stockholder equity section of the balance sheet. Okay. We have common stock, $5 par value, 40,000 shares authorized, issued, and outstanding. We have preferred stock. Now, this is that stated rate we were talking about. What is that? 9%. That is the stated rate. Okay. We have a $100 par value and 1,000 shares authorized, issued, and outstanding. The board of directors did not declare or pay dividends in 2014, but in 2015, the board of directors declare and pay cash dividends of $42,000. Okay? Now, the very, very, very first thing that you must do is this step right here. You have to calculate, using the stated rate, what one full year of preferred dividend would be. And that is calculated by taking the number of preferred shares outstanding times the par value of the preferred stock times the stated value. Okay? In this case, how many preferred shares do we have outstanding?
1,000.
1,000. Okay? Shown right here. What's the par value of that stock?
$100.
$100. That was right here. And then what is the stated value?
9%.
9%. Okay? Which was stated right here. What is 1,000 times 100 times 9%?
9,000.
So one full year of dividends is $9,000. You with me? Okay, you've got to know this amount. You must know this amount before you do anything. Okay? So now let's work through this. What if the stock is non-cumulative? Well, in 2014 it says we didn't pay any dividends, correct? Now it's 2015. Take a look at the screen, guys. Now, we do not have to go back. This is non-cumulative in this case. We do not have to go back and pay 2014. That's just gone. We do have to pay the $9,000 amount for the current year, okay? But we don't have to pay those past years because it's non-cumulative. Once we do that, then we're clear to give common shareholders some cash. And in this case, what's 42,000? Remember we had 42,000? Don't forget that number either. It was back there.
40,000.
Nope. Look on this slide right here. The board of directors in 2015, the board of directors had $42,000 to pay out in cash dividends. Okay?
So that's where we get that remainder of 33.
Yes, that's where you get that remainder of 33. 42 minus 9 is 33. Or think of it this way. You've got a pile of money, $42,000 worth. You just paid your preferred $9,000. Now how much do you have left to give your common? $33,000. Now that's if the preferred stock is non-cumulative. What if the preferred stock is cumulative? And remember, most preferred stock is cumulative. Well, we did not pay dividends in 2004. But now 2005 comes. Well, the first thing we have to do is we have to pay out the dividends in arrears. Now, we can't go back in time to 2014. We're in 2015. But we have to pay the amount that those preferred shareholders were shorted. So we have to pay $9,000 for the 2014 dividends in arrears. Okay, well, we've got prior years taken care of. But now we have to take care of the current year dividend. which is also $9,000. Are you with me? That's for the current year. Once we do that, we're finally clear and free to give the common shareholders some money. How much money are we going to give them?
24.
We're going to give them $24,000. You with me? Okay. All right. Questions? You can come off that.
So, most of the time that you're gonna have to go back and pay someone is gonna be like when your business is starting, basically.
Perhaps.
It's not gonna happen a whole bunch.
That's probably true, but you know, you could go on and have a few years that are lean and you don't pay them. And the preferred shareholders will know though, well, I know this, they can't pay common shareholders before they go up, they catch up. Because again, most preferred stock is cumulative, okay? What I want you to do now is take a look at this handout I gave you called 2 examples of preferred dividends. And I want you to take some time while the music plays and just work on the top half. Just work on the top half, okay? So let's go ahead and roll that music and work on this top half. Okay, folks at home, if you want to keep working on it, you can. I don't allow a lot of time because a lot of times people try to do this and they're like, they have no idea what they're doing. So I'd like to let you struggle with it a little bit and at least read the problem and give it an effort. But let's just do a whole example, okay? So let's look at this, all right? ABC Company was organized in 2012 of January and has 8,000 shares of $30 par value, 4% non-participating preferred stock outstanding, and 9,000 shares of $10 par value common stock outstanding, okay? It is declared and paid cash dividends each year as shown below, right here. That's how much cash they have to pay out. Calculate the total dividends distributed to each class of shareholders under each of the assumptions given. Okay, the first thing that you have to do, guys, is what? You have to figure out the total preferred dividends for 1 year, right? So how do we do that? We take the number of preferred shares outstanding times the par value of preferred stock times the stated rate. You have to do this first or you cannot do this problem. What is the number of preferred shares? 8,000 shares. What's the par value?
30.
What's the stated rate?
4%.
4%? What does that equal?
9,600.
$9,600 is 1 full years of preferred dividends. We have to have that number. Okay, let's do this now. Let's say, first of all, the preferred stock is not cumulative, okay? Okay, 2012 comes. How much do we have? Let's just work it like this. 2012, we have $9,000 to give out. Well, we wish we could give them $9,600, but we can only give them $9,000. We'll give them what we have. How much do the common get? They get jack squat, okay? Now, this is not cumulative, so sorry. 2013 comes. We have $10,000 to give out. How much do the preferred shareholders get? $9,600, okay? And then we're good. We're cleared to give the rest to common shareholders, right? So how much would that be? $400, okay? These are dollar amounts. 2014 comes. We have a little better year, it looks like. We have a little bit more cash. We have $20,000 to give out. How much do we give the preferred shareholders? Hang with me, guys. 9,600. How much do we have remaining to give to the common? 10,400. This is not cumulative, okay? Totally separate case. What if the preferred stock is cumulative? And most preferred stock is cumulative. Well, let's go back and
9,000 again.
okay, let's go back. Ignore this for now. We have $9,000. We wish we could give them $9,600, right? Well, we give them what we have, $9,000. How much do the common get? Zero. So right now, we have dividends in arrears of what amount? $600. Next year comes, we have $10,000 to give out. The first thing we're going to do is pay the dividends in arrears of $600. Now we're caught up for previous years, but we have to pay the current year. How much money do we have left at this point?
9,400.
10,000 minus 600, we have 9,400. We wish we could give them 9,600 for the current year, but we can only give them 9,400. How much money, how much cash does the common get? Zero, right? What is our dividends in arrears at this point?
200.
How much?
200.
200. Now, so in total, they got 10,000 for this year, the preferred shareholders, right? 600 of that was dividends in arrears for the previous year, and then 9,400 was a partial payment of the current year. All right, next year comes, we have 20,000. First thing we have to do is pay the dividends in arrears of $200. Now we're all caught up for prior years. But we have to pay the current year amount. How much do we pay them?
9,600.
Yeah, and we can pay the whole amount, can't we? Yeah. Now we're finally free and clear to give the common shareholders some money, some cash. How much cash is left to give them? 10,200, right? What's the dividends in arrears at this point? Zero. Okay? It's easier when we kind of go through an example, isn't it? Yes. Okay? All right, does that make sense, folks? Okay, let me give you your homework and we'll call it a day. All right? What I want you to do for homework is I want you to do the bottom half of this sheet. Okay? So do the bottom half of this sheet that I gave you. But I also want you to do quick study 13.6 and exercise 13.8 and 13.9. So finish this, do that quick study and these exercises, and we are good to go. Oh, sorry, thank you. We still on? Yeah. Also, do this sheet right here. Cash dividend example. So let me rephrase. I want you to do this. I want you to do that quick study, those two exercises, and also the cash dividend example handout. All right? It's really not going to take too long. Okay? See you later. Bye.